Hi guys, welcome back. As promised, Sanjeev Prasad, the Managing Director, Co-Head at Kotak Instl Equities, joins us now to talk about the markets as well as what the strategy is going ahead. Sanjeev, hi, good morning and thanks for joining us. Your conference is underway, so just to start off, what's the mood like amongst investors? I mean, there's so much political and macro noise at the moment. Are people feeling a bit nervous about investing at this juncture, or is there still quite a bit of optimism?
Because going by the number of investors, people are still very interested in India, that's for sure. But clearly, you're not seeing that interest translating into any money flow as of now. We have seen FI flows have been pretty modest, calendar year to date. And the challenge for India has been that year to date, India's performance has been among the worst as far as most emerging markets are concerned. It's actually down 3% in dollar terms. So look at the Nifty 50 index, whereas the MSCI emerging market index is up 8%. So there is clearly some improvement in investment sentiment for emerging markets, but that is yet to translate into India. And there could be two reasons for that. One is, of course, the fact that India's valuations have been quite high compared to most other emerging markets. So people are not really looking at putting money at this point in time in the more expensive names. In India, the stocks that you really want to own, the private financial names, consumer, staple, discretionary, IT names, they're all, fairly valued to, in some cases, super expensive valuation. So probably that is what is holding back investors. The second point is India, of course, has elections going forward. So I guess a lot of people just want to wait and see, which way the election results play out, and then only take a call. Whereas in some other emerging markets, you've already seen that political risk being taken out of the equation. For example, Brazil, Mexico, you already had elections last year.
Fair point. That makes them more attractive. Sanjeev, good morning. If valuations are challenging, that challenge can be met only if earnings grow. What is the sense? It looks like this year, again, it's going to be at best high single digits, if that. Does next year look promising at all?
See, first of all, on valuation, let me just highlight one point. Of course, the market valuation 16 times doesn't look too expensive, but the problem seems to be as follows. On the one side, you have some 50, 75 stocks which are trading at extremely expensive valuation, which is where probably the investment interest is the highest. And then you have the rest of the market, which is now probably trading at very, extremely low valuation, in some cases very attractive valuation, but there's just no interest in those stocks as of now. So it's a very funny market in the sense you have a bull market and a bear market at the same time. In the Indian market, you have 50 stocks which are probably at all-time highs, trading at super expensive valuations. You have the rest of the market which is at very attractive valuations. So it's a very odd kind of a market in that sense. On the earnings point, if you look at the third quarter numbers, the good thing is that the trends, underlying trends, more or less confirmed, whatever we have seen. So that gives us some confidence about 2020 numbers. So as of now, if you look at for the Nifty 50, we're looking at about 26% growth for the Nifty 50 index. That will look very high, but that is largely coming from the banking sector, where we are seeing a big turnaround in the profits of the so-called corporate banks, just because of the fact that you have seen the end of the NPL cycle, more or less. In terms of recognition of NPLs, slippages have come down pretty sharply in the first 9 months of this year. And provision coverage ratio for most banks has now gone to 60-70%. So presumably, loan loss provisions will start declining going forward. About almost 55% of our incremental earnings is coming from the banks and the diversified financial space. So at least the underlying trends seem to be confirming and giving us some confidence in the 2020 number. This year, we're looking at about 13%. First 9 months of growth has 9% net profit growth on the Nifty 50 index. So I think we seem to be on track as far as earning numbers are concerned.
Okay. The problem is not so much banks anymore. A lot of people are talking about how this NBFC crisis could snowball into something bigger. In fact, we were just having a discussion a while back where a lot of the experts were indicating to us that lenders are not in a position to refinance. The liquidity squeeze continues. What's your own sense? Could it get worse before it gets better?
See, for select NBFC, that is possible. See, but again, you have to keep things in perspective in India. And if you look at the total loans of the Indian banking plus NBFC sector, if you net out the amount of money which is given by the banks to the NBFCs, that's somewhere about 120 trillion rupees or so. If you look at the total exposure of the real estate developers, banks and NBFCs combined to real estate developers, that is somewhere about 4 trillion rupees. And NBFCs alone, have somewhere about 2 trillion rupees. So how much of that will eventually go bad? Even if you take a big number of, let's say, 50% write-off over there, that's only 1 trillion rupees in the context of 128 trillion rupees of total loans in the banking system, NBFC plus banking system. So, yes, it's going to be a problem. It's going to be a big problem for specific companies who have large exposure to real estate developers. But I don't think it's going to be a massive problem for the banking sector as a whole. Remember, we were sitting at 12% NPLs not too far back. So in that context, this 1% number, I don't know whether it's going to create such a big problem as far as the banking system is concerned.
No, I think Sonia was not worried about the banking sector. She was just worried about overall corporate as well as the financial sector. If you include MFs and NBFCs and banks, then can there be something systemic? But good to hear from you that you don't think it lends to a systemic problem. It's more a micro problem for some individual companies. But Sanjeev, more generally, what are you advising the guys who will be speaking to you at your conference? If you say where companies are good and giving earnings, the prices are overshooting, and where prices are terrible, anyway there is no growth. So what do you advise people to buy?
No, I don't think the second part is fair. I mean, you have a decent number of companies where, valuations are attractive with, some amount of earnings visibility. So you have a decent number of companies now, where you can look at, revisiting them. Over the last 6 months, they have seen a lot of correction. For whatever reasons, stocks have come off a lot. But not as if the business models have changed, or collapsed completely. In some cases, yes, obviously there was a lot of fraud which got built into companies' valuations on, people, whatever assumptions people had on the business model that one time. That's obviously got tested, and that is more specifically true in the case of some of the NBFCs where people were, probably assuming that these NBFCs were as good as an HDFC bank, without looking at the fact that none of them have had any liability franchise. They were all doing, basically borrowing short-term money markets and doing long-term lending. So obviously there was a big, challenge over there, but the market ignored that. But if you leave aside that, few set of stocks where you would still see challenges, I think you have seen reasonable correction without any big change in fundamentals in that sense.
Okay, well, Sanjeev, we've run out of time, but thank you for joining us and have a good conference. We'll touch base with you once again post that. For now, let's take a quick break. On the other side of the break, our commodities editor Manisha Gupta will join in to give us all the latest commodity trades. Stay with us.